On March 10, 2023, the financial world awoke to an unprecedented shock. Silicon Valley Bank, a pillar of the technology sector, had collapsed. Its sudden failure triggered a wave of fear and uncertainty, threatening to spill over into the broader financial system. This wasn't just another bank closure, it quickly became one of the largest bank failures in U.S. history, a dramatic event whose repercussions echoed across markets and boardrooms worldwide. How did a bank so deeply embedded in the innovative heart of America suddenly unravel with such speed and devastating impact? The story is a complex tapestry of economic shifts, investment decisions, and the digital age's unique capacity for panic. For decades, Silicon Valley Bank was more than just a financial institution, it was a specialized partner for the burgeoning tech and venture capital ecosystem. Unlike traditional commercial banks, SVB carved out a unique niche, catering specifically to startups, venture capital firms, and high-net-worth tech entrepreneurs. This focus meant it understood the volatile cycles of the tech world, from fundraising booms to lean periods. Its services were tailored, offering everything from payroll for nascent companies to credit lines for established unicorns. This deep integration made SVB indispensable, but also highly concentrated, tying its fate directly to the fortunes of the tech industry. The COVID-19 pandemic inadvertently fueled an unprecedented boom in the tech sector. With lockdowns accelerating digital transformation, venture capital flowed into startups at an astonishing rate. This influx of capital translated directly into a massive surge in deposits for Silicon Valley Bank. Tech companies, flush with cash from funding rounds, parked their funds at SVB, trusting its specialized knowledge and connections. By the end of 2021, SVB's deposit base had more than doubled in just 2 years, swelling from roughly $60 billion to over $180 billion. This rapid growth, while seemingly positive, presented a significant challenge for the bank's investment strategy. Faced with this tidal wave of new deposits, SVB made a critical investment decision. In a period of historically low interest rates, the bank sought to generate returns by purchasing a substantial volume of long-dated U.S. Treasury bonds and mortgage-backed securities. These assets, considered very safe, offered a slightly higher yield than short-term alternatives. The strategy was predicated on the assumption that interest rates would remain low for an extended period, allowing SVB to hold these bonds to maturity and earn their promised return. It was a seemingly prudent move in a low-yield environment, but one that contained a hidden vulnerability that would soon become devastatingly apparent. The economic landscape began to shift dramatically in early 2022. Inflation, long considered transitory by many, became a persistent and growing concern. To combat this, the Federal Reserve embarked on an aggressive campaign of interest rate hikes. Starting from near zero, the Fed's benchmark rate began to climb steadily and rapidly throughout 2022 and into 2023. This decisive pivot by the central bank was designed to cool down the overheated economy, but it also set in motion a chain of events that would directly challenge SVB's investment strategy and expose its critical flaw. The mechanics of the bond market dictate an inverse relationship between interest rates and bond prices. As interest rates rise, the value of existing bonds, especially those with lower, fixed yields, falls. This is because new bonds are issued at higher rates, making older, lower-yielding bonds less attractive. Silicon Valley Bank's portfolio of long-dated U.S. Treasury bonds and mortgage-backed securities, purchased when rates were near zero, plummeted in market value. While these were held to maturity assets on paper, meaning SVB didn't have to sell them, their market value was now significantly below their purchase price. These were unrealized losses, a ticking time bomb on the bank's balance sheet. Simultaneously, the rising interest rates and broader economic uncertainty began to cool the once red-hot tech sector. Venture capital funding slowed considerably, and startups faced a more challenging fundraising environment. Many companies that had accumulated large cash reserves at SVB during the boom began to draw down their deposits to cover operational expenses or extend their runway in a tougher market. This reversal meant that instead of a continuous influx of new deposits, SVB started to experience significant outflows. The confluence of depreciating assets and increasing deposit withdrawals created a dangerous liquidity squeeze. As more startups withdrew their funds, SVB faced a growing liquidity problem. The bank needed cash to meet these withdrawal requests, but much of its money was tied up in those long-term bonds that had lost substantial market value. To generate the necessary liquidity, SVB was forced to do what it had hoped to avoid: sell some of its depreciated bonds before maturity. This meant realizing, or crystallizing, the losses that had previously only existed on paper. It was a painful choice, but one necessitated by the immediate need for cash, and it set the stage for the dramatic events that would follow. On March 8, 2023, Silicon Valley Bank made a fateful announcement. It revealed that it had sold a portfolio of $21 billion in available-for-sale securities at a substantial loss of $1.8 billion after tax. To shore up its balance sheet and address the capital hole created by these losses, SVB also announced plans to raise $2.25 billion in new capital through a stock offering. This disclosure, intended to be a transparent move, instead had the opposite effect. It signaled to its highly interconnected client base that the bank was in trouble, triggering an immediate and catastrophic loss of confidence. The news of SVB's losses in capital raise spread like wildfire, not through traditional channels, but through the highly networked tech community on platforms like Twitter and private Slack channels. Venture capitalists, who often had accounts with SVB and influenced numerous startups, began advising their portfolio companies to withdraw their funds. This digital contagion accelerated at an unprecedented pace. What might have taken days or weeks in previous eras unfolded in a matter of hours, fueled by instant communication and shared anxiety within a tightly knit professional group. The trust that had been built over decades evaporated in a single day. What followed was a textbook, yet digitally accelerated, bank run. Depositors, fearing for the safety of their uninsured funds, as many tech companies held balances far exceeding the FDIC's $250,000 insurance limit, initiated a torrent of withdrawal requests. On March 9 alone, depositors attempted to withdraw an astonishing $42 billion from Silicon Valley Bank. This immense outflow overwhelmed the bank's ability to provide cash, even after its emergency bond sales. ATMs were emptied, online transfers failed, and a queue of anxious customers formed outside its few physical branches, though most of the damage was done electronically. The panic was absolute and irreversible. By the morning of Friday, March 10, it was clear that Silicon Valley Bank was insolvent and unable to meet its obligations. Regulators acted swiftly. The California Department of Financial Protection and Innovation closed the bank and appointed the Federal Deposit Insurance Corporation, FDIC, as receiver. This meant the FDIC immediately took control of SVB's assets and liabilities, initiating the process of winding down the bank. While insured depositors were expected to be covered, the fate of billions in uninsured deposits remained uncertain, casting a dark shadow over the tech industry and sparking fears of broader financial instability. Silicon Valley Bank's collapse was not merely significant, it was historic. With approximately $209 billion in assets, it instantly became the second largest bank failure in U.S. history, surpassed only by Washington Mutual's collapse during the 2008 financial crisis. The speed and scale of its demise underscored profound vulnerabilities in the banking system, particularly for institutions with concentrated client bases and substantial holdings of interest rate-sensitive assets. Its failure sent a chilling message that even a seemingly stable, specialized bank could unravel in mere days, amplified by the interconnectedness of modern finance and digital communication. The panic didn't stop with Silicon Valley Bank. The very next day, Signature Bank, a New York-based commercial bank with a significant crypto industry clientele, also collapsed. Fears of contagion spread rapidly, threatening to destabilize other regional banks perceived to have similar vulnerabilities: concentrated deposit bases, large uninsured deposits, or significant holdings of depreciated long-term assets. Stock prices of regional banks plummeted worldwide, and depositors at other institutions began to question the safety of their own funds. The collapse of SVB had opened a Pandora's box, revealing the fragility of trust in the financial system. Facing a potential systemic crisis, U.S. financial authorities, the Treasury Department, the Federal Reserve, and the FDIC acted decisively over the weekend of March 11 to 12. Their immediate goal was to restore confidence and prevent a broader meltdown. They announced an extraordinary measure: all depositors at Silicon Valley Bank and Signature Bank, even those with uninsured balances exceeding $250,000, would be made whole. This was not a bailout of the bank's shareholders or bondholders, but a critical intervention to protect the integrity of the financial system and the millions of businesses and individuals reliant on these deposits. To further stabilize the banking system and prevent similar liquidity crises, the Federal Reserve introduced the Bank Term Funding Program, BTFP. This emergency program offered loans of up to 1 year to eligible depository institutions, allowing them to pledge U.S. Treasury bonds and other qualifying assets at par value, regardless of their current market price. This ingenious mechanism effectively neutralized the risk of held-to-maturity losses for banks facing deposit outflows, providing crucial liquidity without forcing them to sell depreciated assets. The BTFP was a direct response to the specific vulnerabilities exposed by SVB's collapse. In the weeks and months following its collapse, Silicon Valley Bank's assets were systematically unwound. Most of its deposits and loans were eventually acquired by First Citizens Bank, a larger regional institution, ensuring that its former clients could continue their banking operations. While the immediate panic subsided thanks to government intervention, the incident served as a stark reminder of the delicate balance within the financial ecosystem. The unique vulnerabilities of SVB, amplified by the speed of digital communication, highlighted how quickly trust can erode and how devastating the consequences can be for a specialized financial institution. The Silicon Valley Bank collapse spurred intense scrutiny on banking regulations, particularly those introduced after the 2008 crisis. Critics questioned whether some regional banks, especially those with assets between $50 billion and $250 billion, had faced adequate oversight. The incident highlighted the need for regulators to better account for interest rate risk, rapid deposit concentration, and the potential for social media-fueled bank runs in the digital age. It prompted calls for re-evaluating capital requirements and stress tests for mid-sized institutions, ensuring they are prepared for sudden shifts in economic conditions and depositor behavior. The collapse of Silicon Valley Bank reshaped the financial landscape, leaving an indelible mark on how banks operate and how regulators perceive risk. It served as a potent reminder that even highly specialized, well-capitalized institutions are not immune to systemic vulnerabilities when economic conditions change rapidly and depositor confidence erodes. The crisis underscored the interconnectedness of modern finance, the speed at which panic can spread, and the crucial role of swift, decisive government action in preventing broader catastrophe. SVB's story is a cautionary tale, illustrating the perpetual challenge of balancing innovation with stability in a dynamic global economy.